Hey everybody, this is Brant from Wolf on Wall Street Trade and the technicaltake.net. I have a pretty interesting update for you for the stock market. We got a really interesting signal, a very rare signal on Friday the 14th. It's over here. This is a daily chart of the VIX. And we've gotten another 3 cents. If you remember my Stranger Signals video from, I think it was July, right before the tech wreck, this was one of the ones we got. Very rare to get. Before that July one, we hadn't gotten one until the end of 2021, right before the bear market. So the way I use this signal, it is a breadth indicator, but what it tells us is that the market's unstable. Market breadth is unstable and it's acting toppy. So when we get just one signal, and we have 4 here that are painted in these yellow bars, just one signal on average from my research and the levels that I use, we get a move in volatility in VIX of about 50% over the next 1 to 30 days. That can vary a little bit. We've had moves come 5 weeks later. We've had moves come the very next day. We've had volatility shoot up over 400% like in July and August. And we've had volatility shoot up over 500% like Volmageddon in 2018. All of them had these ABI signals. Of course, when volatility is higher, that means stocks are down, and we saw that towards the end of this past week. So we got the first signal Friday the 14th, and on Thursday the 19th and Friday the 20th, we're seeing market volatility already. I posted the first signal on X, formerly Twitter, on Tuesday, so if you follow me there, you would have seen it or had the opportunity. If not, follow me. Also, if you sign up for our free newsletter at either The Technical Take or wolfonwallstreet.com, you would have gotten the post as well. And this was the chart that was included with it. This was the last time we got a series of these signals, 8 in 9 days, a 400% move in VIX over 65, following that shortly. And this was as of Tuesday when we had 2 signals in the bag. Now we have 4 consecutive days. So this last cluster that shot VIX up over 65 in this enormous move, over 400% from where we got the first signal. We had some people trading VIX or trading VIX futures options make a lot of money on this. That was the tech wreck in July where the NASDAQ dropped about 15%. We had the carry trade unwind and all that. We have aspects of that too now that I'll get to. Here's a close-up of this particular move, and there's the signals right there, so you can see they preceded the move by a couple weeks and over 400% from the time we got the signal in VIX up over 65. Really spectacular move, one of the biggest moves I've seen in VIX in one day in a long time. Here's the NASDAQ 100 from that same period. This is when I did that video, Stranger Signals. This was one of those signals. And you can see NASDAQ came down 15% after all these signals. And if I paint them right on top of the bars, these were the signal days. So you can see the market did still move up, but then just crashed really hard. And before the signal last summer in 2024, the end of June into July, we had not gotten one until late 2021 when the market was topping out back here, the S&P 500. That's actually what a really low reading, which is what these yellow bars are. They're printing a specific level that I've researched over the years. And what it says basically is that the market is acting toppy, that breadth is more consistent with the slow topping process of a market that's going through a top. But you can see we have this kind of head and shoulders top here. We have signals at each one of them, and we had big volatility moves at each one of those. So 73%, 67% from the first day of the signal, and 61%. So these were in late 2021, very early 2022, and that was in these areas preceding this bear market in 2022. So we have that same signal right now. Like I said, it came February 14th, and then we get into this week. That was last Friday, so a week ago, we got the first signal, and we've gotten them every day this week since, except for this Friday. And you can see what's happening here in the S&P 500 on Thursday, coming down, bear flag, and then a big drop on Friday. So again, the signal, if you know what it means, my subscribers love it because they know how powerful it is. They know how probable it is. I'd say it probably has a 90% hit rate. So these last 2 days of the week, Thursday and Friday, where we're seeing some volatility in the market. We're seeing the averages come down. S&P's down 2.1% last 2 days. NASDAQ 2.5%, Dow 2.7%, small caps almost 4%, 3.85% in the last 2 days of this week. These signals preceded this move by several days. The thing is, having some experience with this indicator, knowing how deep it went and knowing how many signals we got consecutively, I think what we're seeing here is just the start. And I'm going to get into that a little bit more. I do think there's a good chance of some consolidative corrective activity early next week. We're going to look at all that, but first let's kind of take a look at the big picture, what's been going on specifically since the election. So here's a daily chart of the S&P 500. Here's the election, the gap up. In my January 12th, I think it was my January 12th video, which was the weekend before this day and this day over here, I said if the S&P 500 holds 5830, I think that we're going to rally. So we got this rally. Then for my subscribers that get all this information in real time, intraday, every day the market's open, I said that I think we're going to make a right-hand turn into earnings season, which is kind of a lateral trend. And the market's going to kind of stay in that until it gets a feel for what earnings growth looks like. You could see that we do have this zone of resistance here. S&P's tried to pop above it, made two new record high this week, and then just broke back down above. So it's been having trouble around this 6100 area. And we've had a lot of tariff news. So like over the weekends, we'll see the market sell off on a Monday here, or sell off on a Monday here. And now we get towards the end of this week with some selling, and we got the signal right over here ahead of all that selling. The earnings I think the market was most interested in is the Mag 7 stocks, the mega cap stocks, because they pretty much drive the entire S&P 500, and because they derive about 49% of their profits outside of the United States, whereas I think small caps is maybe something like 24%. It's much lower. So they've got a higher risk to retaliation with regard to tariffs. The outlook that we got after we started getting that 2-week period of mega cap earnings, we started to see a lot of deterioration. I'm not going to say a lot like crazy distribution, but we saw a deterioration in 3C. We saw selling of the mega caps in the underlying money flow. So any number of indicators or of assets in the mega cap shows that, but I'm just going to use one for right now, MGK, the mega cap growth index. And over here we get, one of these sell-offs on weekend news, on tariff news, and a rebound. And 3C is in line here. It's confirming. So it means the price trend is fine. No worries, right? This is the area where we start to see those mega cap earnings come in. We had 2 weeks of really heavy mega cap earnings. And that is where we're starting to see 3C negatively diverge right after that. And then we see the sell-off after we're getting these ABI signals over in here. So I don't think the market was happy with it. It's not whether or not they beat earnings. It's really the rate of change of what their guidance is. Do they expect their earnings growth to be growing? Like, think of a bell curve. Is the rate of change accelerating or decelerating? And in the US tech sector, it is flattening out and starting to decelerate. So a lot's been priced in, a lot of optimism. And after we got the tech earnings, we started to see these negative divergences like over in this area with MGK. If we look at the semiconductor ETF SMH, it's filling the gap, and you see 3C is either confirming or leading until we get into filling that gap and until we get some of those tech earnings. Even though we haven't gotten Nvidia yet, we can see the same trend over here where 3C is not confirming. It's starting to negatively diverge with price in this area as we got the mega cap earnings. And then kind of going back and looking at these tougher areas for the market averages, like we looked at the S&P 500 with this resistance zone around 6,100, or if we look at the Dow Jones Industrial Index, it's got the same kind of resistance zone up here around 45,000. So here's the election, bumping into it. This is a December window dressing, sell everything that's not tech to buy tech. The art of looking smart. Here's the bounce back into 45,000 and breaking down below this minor support level over here the last 2 days of this week. Pretty ugly close. But the point is, it's kind of a tough area anyway with this resistance here for the Dow, for the S&P. Same thing for the NASDAQ 100. Pull that up. We have this resistance here, and price bumps into that and sells off again. I was really interested coming into 2025 because I knew with the window dressing, there wasn't going to be any rotation. It was going to be the start of the year. And with mutual fund inflows, all kinds of passive fund inflows at the start of the year, I was really interested to see if we were going to see the domestic small caps and mid caps start to show some leadership. The answer is no. So to the far left over here, the election, small caps just blew away everything on the election. They did better than all the other averages. There was a lot of enthusiasm for small caps when Trump won election night over here. We're seeing small caps just sat on by the 50-day moving average. So technical resistance, that doesn't speak well of any kind of leadership coming from small caps. And you can see them roll over the end of this week over here. So we're about 7 weeks into the new year, and there's no apparent leadership. It's not coming from mega caps. It's not coming from small or mid caps. That's a problem for the market when we don't have clear leadership, when there's not a narrative like this time last year. AI was the driving narrative for the market. That was the leadership for the market. We don't have that right now. And that has become very apparent in a kind of a little bit longer term price pattern that we're seeing in the benchmark S&P 500. This is the election, this big gap up, the election night right here. And what we have is a broadening formation. So broadening formation is a trend of higher highs, right? Which we have over here, higher highs, got higher highs this week, and lower lows. So we can see those over here. Now the trend lines don't need to be exact. That's not the point. The point is the pivots, the higher highs, the lower lows, this broadening or megaphone type formation. You don't see them that often, but what it represents is like chaos. It represents volatility because each swing is getting bigger and bigger. Could we come all the way down to the bottom here and make a lower low? Absolutely. It's indecision. Think about what I just said about market leadership. It's disagreement. It's a market that's whipped around by rumors and news and speculation like we saw over here with these weekend closes, then tariff news and gaps down. That is exactly the environment that this broadening formation is depicting. Most of all, it's depicting a lack of institutional intelligence sponsorship or leadership. We're not seeing the leadership that we used to from the mega caps. We're not seeing the small and mid caps and the pro-cyclical growth sectors stepping in. We're just in this kind of vacuum of leadership, and this is the kind of pattern you get with that. I mean, this pattern doesn't surprise me at all, given everything that's going on. Market breadth is very poor. So if we look at this custom indicator, this is the NASDAQ 100. This white line is the percentage of NASDAQ 100 stocks that are above their own simple 200-day moving average. So we have the NASDAQ 100 stocks. How many of them, what percent are above their 200-day moving average, which is a long-term moving average. Here's the last time we got the ABI signals, the tech wreck, with some unwinding of the carry trade. And since then, you can see it's just gotten worse. You can see the trend is all lower highs. So we have, instead of 75% of the stocks in the NASDAQ 100 above their own 200-day, we have 69%. It's going down. It's moving down lower. If we look at the 50-day, it's even worse. This is really kind of interesting because when we look at the long-term 3C trend or the long-term underlying money flow trend, it looks very similar to this area. So let's take a look at that for QQQ. Over here, we have confirmation, some divergences, and then we see price move down, some divergences here. But overall, the trend is kind of confirming. Here's the tech wreck of last July into August, 15% decline. And we just have not seen the money flow return like it had been over here since then. And this is what I've kind of been saying to subscribers since this tech wreck, especially. we have not seen the mega cap leadership that we saw the prior 2 years, or starting in, January of 2023, when the mega caps came into leadership. So the same kind of thing that we're seeing on the breadth over here, where fewer and fewer NASDAQ stocks are above their own 200-day moving average, we're seeing that in the underlying money flow. And it's the same thing for the S&P 500. So we look at this one, the percentage above their 200-day, so all the S&P 500 stocks, and it's usually running up here around 75 to 80% when we're in a bull market or a primary uptrend. And you can see since that tech wreck and since the Fed cut in September and progress on inflation stalled, we can see that's moved down to 60%. We should be up in the 75 to 80%, especially making 2 new record highs this week. We look at the long-term underlying 3C money flow trend, and it is the same thing. Here's, for those that remember, we had small head and shoulders. It was a 500-point 3-month decline over here from 4,600 to 4,100. 3C's negatively divergent. Then we get a big surge with short covering, confirmation. But here, as we get into basically from where the tech wreck started over here, or where the Fed made that first big 50 basis point cut, which seems like a policy error, we are seeing a negative divergence in 3C. And just draw it in for you. Simple as that. Same thing in the NASDAQ, which is what we're seeing in market breadth as well. And that brings us back to our recent ABI signals, like we saw back here in July before this 15% crash in the NASDAQ 100. When we see these signals, what it's telling us is that we're in an environment that is ripe for this kind of decline. It doesn't necessarily say, hey, it's going to be tomorrow. It just says the environment is right. Market structure, market breadth is poor. This is the 2021 top I was telling you about. And exactly what this indicator tells us is when we're getting these signals that we're in an environment that is more consistent with a market that is topping. This is a top. Here's kind of like a left shoulder, a head, a right shoulder. We get ABI signals at each of them before we go into 2022's bear market. The moves in VIX, each time we get one of these signals, and usually this is what I use these signals for, is trading volatility, because we get some spectacular moves very quickly, and the signal has a very, very high hit rate. We get those signals about a week ago, and now we're starting to see selling in the averages. And smart money is aware of it, because the day after we got our first signal, the CBOE skew index prints a new record high on Tuesday, the 18th of February, at 183. I mean, when the CBOE white paper came out on skew, 150 was like red alert levels. That was like the highest they had ever seen. We're up at like 183 Tuesday, a couple days ahead of the selling this week that we're seeing. So this is institutional money, a lot of long onlys, pension funds, mutual funds, stuff like that have to be long, trying to find ways to hedge and protect against black swan risk. The VIX is the fear index. The skew is the black swan index. Basically, what it means is that these funds are spending a lot of money to bid up deep out of the money puts. So institutional money is aware of this, and they're hedging. And at the same time, as we've been going through earnings season, 3C's been kind of confirming along. A lot of retail money had been flowing in, mom and pop investors. And 3C had been confirming. We were watching the short-term time frames because they moved the fastest for signals, and we started to see a change in character the very day after the first ABI signal. So if you remember what I was saying about my forecast about if the S&P holds 5830, we're going to rally, then we're going to make a right-hand turn into earnings season. Here's that right-hand turn that we're looking at on SPY's 1-minute 3C chart. And here's the 14th where we get that ABI signal. So 3C up until that point is pretty much confirming. As a matter of fact, even like when we get dips in price, we see positive divergences in 3C at these dips in price. So it's confirming. We're waiting for earnings season. Here's the first ABI signal. Then we get a change in character. Here we are in the 14th, change in character. 3C starts to negatively diverge, particularly into these 2 record highs that we got this week. What I always say is that changes in character precede changes in trends. It's very rare, if you're paying attention, it's very rare that you get a change in trend and the market didn't warn you first with a change in character, something subtle, not a sell-off and, volume spiking and the obvious stuff, but something subtle like this, which is what we saw in 3C. And as we come down on Friday into technical support, you can see the buyers stepping in, and we get two higher lows in 3C. So small relative positive divergence as we come into technical support. So here's the daily S&P chart. Let me just zoom in a little bit. Our two new record highs. Here's Thursday selling. Here's Friday selling. That's the 50-day moving average. That's the technical support. So what we're seeing on 3C on that last chart is technical buyers kind of stepping in into the weekend, just as they did here and over in this area and over in here. If we look at the other averages, just about all of them ended at some sort of technical support. We'll go back to the election. That's the election gap up right there. Here we are this week. So if we look at the Dow, for instance, it came down, closed a little bit below the 100-day, but let's just call that close enough. I think it's close enough. The NASDAQ, or Dow Transports, right there at the 200-day, so they tested below it. They held it as of the close on Friday. If we look at the NASDAQ 100, it's pretty close to the 50-day, so maybe it comes down and tests that. Not necessarily close enough, I think, but maybe it tested on Monday. And then if we look at small caps, pretty close to the 200-day, closing near session lows. That's always an ugly look. So 50 days acting as resistance, kind of holding up, right in that 200-day moving average area on the close on Friday. That's going to play into our outlook for next week. Other than technical support, the price action looked horrible into the close on Friday. So here's a 5-minute chart of the S&P 500 on the week. Last week, that's the 14th, Friday the 14th. Sell-off, bear flag, sell-off, and this is technical support around 60.10 there, but it's ugly price action. There's no kind of base. There's nothing interesting there, just that technical support at the close. And now with options expiration in the rear view mirror, about 50% of the gamma rolled off with options expiration, which means the market is freer to move, and that's in both directions, both up and down. So my thought is, and we'll just have to see how this goes, my thought is that if we don't get any kind of political or geopolitical catalyst before then, I think the market is going to try to consolidate or correct, perhaps consolidate in something like a bear flag like this, which would be really interesting because it sets up a great trade, into Nvidia earnings, which is Wednesday after the close. That's the final mega cap to report of the Magnificent Seven. Now, I have no idea what Nvidia is going to report, what the forward guidance is going to look like. I think DeepSeek, it's not going to displace OpenAI or anything, but I think DeepSeek did a lot of damage to a lot of these companies that have been spending billions in CapEx on AI. I think Google search is in particular danger. So why go to Alphabet's homepage, Google's homepage, and do search when you can do it on any AI platform and a lot of them for free, much easier and much more comprehensive. In any case, looking at the semiconductors as we're going into Nvidia earnings on Wednesday, the SOX index. First, I've been watching this kind of big head and shoulders with an elongated right shoulder, left shoulder head, elongated right shoulder. We've been watching this for a while. Neckline right down here around 42.80 or so, 42.75. What the semis did was just fill this gap. So here's the gap. I think it might have been from DeepSeek. I can't remember exactly, but filled that gap. If we zoom into it here on the daily chart, here's that big gap down. All price did was move in to fill this gap. Gaps are it's amazing. I mean, I've been watching this for decades, and it still amazes me every time how gaps are just like a magnet for price. So from down here, it's going to fill the gap, 9 times out of 10. But what is interesting is what has happened as this gap was filled, especially as we get towards the end of it over here this week. On a 60-minute chart, it almost looks kind of like a bear flag, the way it filled it. So you have the flag pole, and then you have the flag. I'm not saying it's a bear flag, it's a little bit too big, but to fill that gap, the tone of the gap fill was not all that constructive, is what I'm saying, in the price action. And then if we get into 3C, take a look at that. So here's the SMH, the ETF for the SOX index. And here is the gap down. And look, even into the gains over here, what we see is selling into the gains. This is how institutional money operates. They have such big position sizes, they can't sell into a drawdown. They make it worse. All right, they want to get out, they want to sell into demand, so they will sell into gains. And that is the beauty of 3C, is that it has the ability to follow the money flow and contradict price and give us divergences like this. But here is the gap fill, and 3C is pretty much in line, confirming. It's like, okay, we're not going to short this, we're not going to do anything with it right now, but it's probably moving to fill this gap. And as we get closer and as we fill the gap, look what 3C starts doing. Starts acting real ugly again, like it was over here, right as that gap is filled. And as we're going into Nvidia earnings on Wednesday. Again, I don't know what they are. We'll be watching the 3C charts of Nvidia. But what I'm saying is the SOX index itself, not looking great. Whether it's the longer term pattern of that kind of head and shoulders and it hasn't been able to make a higher high, or whether it's just watching these gaps being filled or selling in to price momentum, selling into gains. And then sort of like the July-August tech wreck sell-off, where we also had a carry trade unwind in the US dollar, Japanese yen, the dollar-yen pair. I started warning subscribers earlier this week. I think there's a problem here too. This could crop up. And then the Bank of Japan that night came out and said that they're going to try to support and keep stability in the dollar yen. But still, we're seeing signs of carry trade unwind. So hedge funds will finance long positions in stocks with the US dollar, JPY, Japanese yen. And here we're looking at NASDAQ futures in the candlesticks. It is a 15-minute chart. USD JPY here in the blue line, and you see this trend of carry trade being unwound, or the dollar yen heading lower. This is what I was warning about. Here's the Bank of Japan that night talking about it. So I was warning about this being an exacerbator of a sell-off like we saw in July, right? And if we look closer, what we'll see is the NASDAQ following this carry trade, right? We see the carry trade being unwound late this week, Wednesday, Thursday, into Friday. And then if we look at a shorter time frame, what we see is the carry trade being unwound, stocks being sold off. It's actually leading. So we're seeing the financing that is used to buy by like hedge funds and stuff, to buy stocks on the long side. We're seeing them shut that financing down, close that carry trade out, and get out of long positions they had in tech, right? Or in other stocks too. So this is one thing I was watching late Friday afternoon for members. I think I posted this in the afternoon update. It was like, okay, some of the bleeding has stopped here in the carry trade, where we have some higher lows over here. And that only started as we started to come down into those technical levels on the major averages, the 50, the 100, the 200-day moving average. This is an exacerbator like we saw in July. So NASDAQ sold off over 15%. If the carry trade hadn't been unwound, maybe it would have been a 7 or 8% sell-off. But with the carry trade being unwound, it was much more brutal, and we're seeing signs of that as well. So kind of putting a bow on this, we're like 7 weeks into the new year. We should have seen rotation in the first 2 weeks of the new year in January. Did not see it. We should have seen leadership, have not seen it, and we're 7 weeks or so into that new year, right? We also have signals like our ABI over here that are popping off and that are reflecting that lack of leadership and are reflecting a market structure that is not healthy, that is toppy, which is why we see these big moves in volatility as stocks sell off. So if you go back and look at my, I think it was July, my Stranger Signals video, you will see me talk about ABI, and you'll see that video before the market sold off. So look, I'm not saying you have to go out and, be Mr. Bear and short the whole market. I think it's really time though to consider battening down some hatches, getting ready for some volatility. If you have a lot of long exposure, think of ways to protect that. If you want to trade this, think of ways you want to trade this. Volatility is notoriously hard to trade, but we've had some subscribers make some incredible money trading it because volatility is sporadic. It's not trending. So you get these sporadic bumps, then they're gone. You've got to be fast. You've got to be quick on your toes. If you're working a 9 to 5, it's probably a hard thing to trade. We're seeing institutional investors hedge. Record in the skew index this past week means institutional managers are buying deep out of the money puts to try to protect their portfolios. What are they trying to protect it from? Take your pick. It's black swan risk, tail risk. Could it be tariffs? Could it be Ukraine? Could it be something we haven't seen yet? Could it be, who knows? But I feel like from the timing of the signals with ABI, with skew, I feel like Nvidia's earnings are a big deal. And from what I've seen in how the market has reacted, how 3C has reacted in total, not to every single mega cap, but in total, I think this Wednesday is probably a very, very pivotal day for the market. Wednesday after the close when Nvidia reports earnings. Unless something crazy happens this weekend or before Nvidia's earnings, I suspect what we also see is the market try to correct a little bit of the sell-off on Friday, which was ugly, 1.7% in the S&P in one day, ending near session lows, but holding that 50-day moving average. And I suspect it probably happens in a bearish consolidation, probably something like a bear flag. I mean, I don't want to get too ahead of myself here, but just probabilities, I would say that we see, something like this, where price kind of bounces up a little bit in a parallelogram against this preceding trend, which is a bear flag. If it is, it gives you a great opportunity to get short something for a short trade on that kind of correction into that bear flag. The bear flag is telling you the tone of the bounce because we saw a little mini one right here, intraday Thursday. It's telling you the tone of this bounce is bearish and expect a second leg down. We got a big second leg down. It was way more than the measured move over here. But that's what I am kind of leaning toward. For subscribers, you'll get this information in real time. And as it happens, we'll be analyzing it and putting it through the grinder and saying, okay, there's opportunity here or there's a risk there. What everybody needs to watch out for is VIX over 20. Got really close over here on Friday. VIX goes above 20 and it's just like fear feeds on itself. And you get into this feedback loop of fear and stocks just keep selling off. So 20 is kind of like that level. When VIX breaks through that, kind of all heck breaks loose. I've got a lot to say on gold, silver, Bitcoin, commodities, rates, and basically the macro outlook for the rest of the year. Because some really, really interesting stuff is happening, but I'm not even going to try to touch that in this video. There's a lot here. If you haven't already, follow me on Twitter because I put these things out during the day. If you haven't already, you can sign up for free posts at thetechnicaltake.net or at wolfonwallstreettrade.com, which is our main site right now. And if you really want to get these insights real time, then subscribe at wolfonwallstreettrade.com, and I'll have the links for that stuff in the video description. And we'll see how the week goes, and maybe I'll check in inter-week or most certainly probably next weekend. So there's a lot on the table right now. I just think it's a good time to be reviewing stops, reviewing risk management, battening down the hatches, and probably be good for the market to shake some of this out and see if we can find some leadership to move forward. Have a great weekend, everyone.